Hey there, Brad Castor from GreatOptionTradingStrategies.com. I know we're now a bit past Christmas, but this time of year we celebrate the arrival of three wise men bearing gifts. It's a season of giving. But as option sellers, either put sellers or covered call writers for income, what we have to guard against the most, any time of the year, are three guests who aren't there to provide gifts or income. Just the opposite, in fact. They show up to take income away. But good news, they only show up if we invite them, so it's entirely in our control. So in this video, I want to look at the three biggest option selling mistakes that can lead to problem trades, and potentially even worse than that, unrepairable trades. Before we dive in, just a reminder, as always, I have a lot of terrific option selling resources for you in the description section, and they're all free, so be sure to check them out. Also, any video or side article I make references today will be linked below as well. Okay, let's get started. In these videos, I often make a provocative statement that if you're an option seller, you should not be losing money, except in rare cases. And the more you avoid the three put selling and covered call selling for income mistakes we're going to go over today, the more rare those cases should be. Now, just to be clear, you're always going to have trades that move against you. But the saving grace of being an option seller is that, providing you're not self-sabotaging, you can repair your bad trades and almost always still walk away with okay to decent to even good and sometimes even very good returns. So when I talk about trade repair, I'm not talking about just fighting Mr. Market back to break even or some kind of grueling stalemate. Case in point, inside the Leveraged Investing Club for the full year 2025, we officially closed 46 trades, and all of them were winning trades, even though a number of them were at one point underwater, and sometimes by a lot. Now check this out. Of the 46 winning trades we exited this year, 34 produced double-digit annualized returns. So that means the other 12 must have generated single-digit annualized returns, which for trades that totally went against us, that's still remarkable in itself, right? But that's not how things played out. Of the 46 trades that we closed in 2025, only 4 of them generated single-digit annualized returns. That's because 8 of the closed trades produced triple-digit annualized returns. In other words, 41 of our 46 closed trades, or 89.13%, generated double-digit annualized returns or better. And while we currently have a small handful of open trades in repair mode, nothing we can't handle, we didn't book a single loss in 2025. I've actually put together videos drilling down on some of the 2025 repaired trades, and there are links in the description section below, such as a 300-day option selling repair campaign inside the Leveraged Investing Club on Abercrombie & Fitch, where at the low point, the stock fell 43.56% on us, and yet we not only didn't book a loss, we actually walked away with 17.59% total gains, or 21.41% annualized over those 300 days. And over the summer, I posted another video, Making Money on Bad Trades, where I documented 4 trades earlier in the year where the underlying stocks basically fell 35 to 50% on us, and we still made money on them, including a couple that generated some really good returns. I've also put together an entire playlist on naked or cash secured put and covered call trade repairs. But just because you can repair option selling trades, that doesn't mean you should just randomly sell cash secured puts or covered calls for income because you think, hey, if anything goes wrong, I can just repair it later. Or said another way, just because it's heads you win, tails Mr. Market loses, you still want to flip heads as often as possible. The good news is that you actually have a lot of control over the coin toss. And in this video, I'm going to go over the 3 biggest option selling mistakes that can lead to problem trades and possibly even make them unrepairable. If you want to trade like we do inside the Leveraged Investing Club, where we see ourselves as the insurance company from hell that sells lots of premium but then avoids like the plague ever paying out a claim or booking a loss on a trade, also known as heads we win, tails Mr. Market loses, you're definitely going to want to make sure you're not unintentionally inviting any of these income thieves. And you especially want to stay tuned until the end, because thief number 3 is the worst of them all, and that bastard is everywhere. Okay, thief number 1, or option selling mistake number 1, selling puts and covered calls at tops. So self-sabotaging thief number 1 can show up when you sell puts or covered calls for income on stocks that are at or near their highs. It's very simple. The higher a stock trades, the more room it has to fall. Now, I completely get that's a bit of an oversimplification, but inside the club, we're more focused on value situations than momentum situations. Selling options on richly valued momentum stocks and riding a longer-term trend can be a valid approach. But at some point, that trend can reverse and those stocks can lose a lot of value very quickly. So hopefully you've banked a lot of premium on the way up, and it may be better just to give a big chunk of it back to Mr. Market and bail on the campaign, because repairs could be long and grueling. And with that approach, hopefully you won't have entered a new position right at the top so that you don't have much of a buffer to begin with. Now, I'm definitely not trying to make a straw man argument here, but for me, it's always made a lot more sense to sell puts when a stock is already beaten down and cheap, rather than when it's overvalued, overbought, and priced to perfection. Here's one of my favorite examples, and it's a classic because it really illustrates the potential risks of selling puts at the top. Imagine selling puts on Chipotle in the fall of 2015 when the stock was trading around $750 a share, only to have a 2-year sell-off that takes the stock all the way down to the low 300s. And the fact that it took 2 years to finally bottom is also pretty brutal, because at the end of the day, even though, as I say, option selling is very flexible and forgiving, you can't fully repair one of these trades until the stock actually stops going down. It doesn't have to come back all the way, of course, especially the more you're able to work the strike price lower, but at some point the stock is going to have to rebound at least some. Now, I don't know. I definitely wasn't in a $750 short put trade on Chipotle, but there was a pretty good rebound attempt at the beginning of 2016, so maybe there was a chance to have repaired and exited the trade at that point, but I suspect not. I suspect it might have provided a nice opportunity to further work the strike price down, but probably not actually repair and exit. Also, the first half of 2017, you had a nice counter-trend rally, which would have brought some relief and a better chance of repairing and exiting the trade, providing you were effectively working the strike price lower over the course of the campaign. But the point here is that the more potential downside there is to a stock, the less guarantee there is that you'll be able to repair it. Or if you are able to do it, it's just going to be harder and more time-consuming to do it. So again, inside the Leveraged Investing Club, we come at it from a value investing perspective. We want to sell puts and covered calls for income on stocks after they've fallen, not before. I love selling puts and covered calls on stocks that have already gone through a carnage phase. The key here is to wait for clear signs that the bottom is in, and those can end up being super easy and lucrative trades, basically ensuring the current value of property after that property has been seriously damaged. Obviously, you never know what's going to happen after you enter a trade, but you can do a lot to stack the deck in your favor. If you want to see a textbook example, I've linked to a video in the description section called Perfect Put Selling Trade Entries, or How to Catch a Falling Knife, where we waited 11 days after Lulu started selling off before we entered the trade, and it was one of our best trades of the year. Now, one other note about not selling at or near tops. That doesn't mean just avoiding richly valued growth or momentum stocks. It also means paying attention to the technicals and avoiding selling puts or cover calls on stocks trading at or near resistance levels, or when they're technically overbought, meaning if they have an RSI reading of 70 or higher. Like this example with ELF. Now, right here, where the stock was trading at or near a recent high, would have been a bad time to make a bet that the stock wouldn't be trading lower, which is what you're doing when you're selling puts or cover calls. That's not to say that the stock couldn't push past those earlier highs, but there was a definite risk that sellers would come in where they came in last time the stock traded up to those levels, which is exactly what happened. Now, I know a lot of folks are in love with entering trades based on a low delta, which I think often provides a false sense of security. The problem with delta is that it doesn't take into consideration basic technicals, which at the end of the day is really about market psychology. And without an awareness of market psychology or a way to gauge market psychology, nothing Mr. Market does will ever make any sense. Bottom line, from my perspective, you're going to be much safer and your life will be much less complicated when you sell puts at or near their lows rather than at or near their highs. Okay, option selling mistake number 2, thief number 2. Selling puts on unprofitable businesses. Self-sabotaging thief number 2 can show up when you sell puts or covered calls for income on stocks of unprofitable businesses. Inside the Leveraged Investing Club, one of our insurance company from hell underwriting policies for our core sleep at night strategy is that we only sell puts on stocks of businesses that are firmly profitable. It's real simple. If the underlying business is firmly profitable, it can't trade down to zero or near zero. And as long as a stock can't do that, we feel we can repair just about anything Mr. Market throws at us. But this attitude or perspective is not something in a vacuum, because we stack the deck in our favor in multiple ways, mostly by avoiding other self-sabotaging moves, like selling puts at or near their highs, or by inviting thief number 3 to the party. At the end of the day, when entering a trade, we want whatever the worst case scenario can be to be as benign as possible. And selling puts on an unprofitable business can lead to an unrepairable situation and significant losses. Case in point, back in 2022, I was forced to take a big loss on a club trade on Stitch Fix to the tune of about $3,500. Ultimately, the problem here is that Stitch Fix was never firmly profitable. It was only briefly profitable. Now, the company never filed for bankruptcy, and the stock is still around and trading around the $5 share price level. Theoretically, then, it might have been able to be saved or at least improved a lot. And I see that since I pulled the plug on the trade, that the company's losses have narrowed quite a bit. But the problem here is that the lower a stock trades, the harder it is to repair. You've heard of the law of large numbers? Well, there's what I call the law of small numbers. The lower the strike price you're working with, the less net premium you're able to get, even as the percentage difference between nearby strikes become larger. In other words, it just gets harder and harder to make progress on repairing a trade. Plus, by the end of the Stitch Fix trade, I had no confidence that the company would even survive. When we entered the trade, the stock was trading above $40 a share. At the end, it was trading below $4. Now, we actually did repair a trade with an 80% drawdown, Spirit Aerosystems, right at the beginning of COVID. Quite the timing on that one. But that one did finally rebound partially. With Stitch Fix, the drawdown was more than 90%, and whatever the recovery the stock made since then has been pretty meager. Finally, I get that by only selling puts on profitable businesses, that would rule out a lot of growth stocks, even high-quality businesses still in their unprofitable stage. So selling puts on those kinds of stocks would be something you'd have to make your own determination on. And those obviously can be very valid trades, and I trade plenty of them in my personal account. But for our core sleep at night trades we do inside the Leveraged Investing Club, we don't sell puts on stocks of unprofitable businesses because we never want another Stitch Fix situation. Bottom line, you should simply be aware that unprofitability does remove one of your safety harnesses because unprofitability can eventually lead to bankruptcy or near bankruptcy in penny stock land. And by then, there may not be anything you can do. Okay, finally we come to thief number 3. Option selling mistake number 3. And he's the worst one of all because he's sneaky and slippery and can take even a routine trade repair situation and completely sabotage it. Of course, he's not the one sabotaging it. It's you and I who are the real saboteurs because we're the ones who invite thief number 3 into our trades and our portfolio in the first place, but frequently without even realizing it. And when I say thief number 3, I'm talking about over-leveraging. And in many ways, this is the biggest and most common risk you're going to face as an option seller. It's insidious because it's so easy to do, and it takes different forms, and it's often a very gradual process. And you can get away with it for a long time. So it's also easy to get lulled into complacency. Now, over-leveraging can take place at the individual trade level, and it can take place at the portfolio level. But at the end of the day, when there's a day of reckoning, it's going to be at the portfolio level. Maybe you have too many positions open, or maybe the open positions are too large, or maybe they're structured in such a way that their capital requirements will dramatically increase if you want to manage or repair them, which we'll go over. And then one of those trades, or several of them, or most of them, move against you too much for you to be able to effectively deal with them. Now, if you keep everything on a cash secured basis, you're not going to have any of these issues. And inside the Leveraged Investing Club, I encourage club members to do just that. But I'm also pragmatic, and I understand that margin can be used responsibly and moderately and can significantly boost your returns. And it can help in the trade repair process too. I've also shared a personal adage with club members: use margin to get yourself out of trouble, not into it. So it all starts at the individual trade level and your opening position size. In the Sleep at Night High Yield Income Strategy course inside the Leveraged Investing Club, I advocate for what I call relatively small opening position sizes. Ultimately, it's going to be up to the individual trader to determine what that means for him or her. For me personally, I target opening position sizes that are roughly 8 to 12% of my cash secured capital. Interestingly enough, that means that a fully invested portfolio would typically have around 8 to 12 open positions at any given time. And I feel that's more than enough diversification for the strategy. But we do have club members who are more conservative and won't commit more than 5% of their capital to any new trade. And that's fine, of course, but it also means you're going to have to find more trades to keep your portfolio productive, and it means more work in terms of monitoring and managing your open trades. Now, the reason we start with a relatively small opening position size is that on maybe 5% of our trades, we end up expanding the number of contracts in a position in order to repair it. And we never know in advance which trade that's going to be. So we want to keep all of them small just in case. Of course, it doesn't matter how small your position sizes are, you can still over leverage by having too many of them, especially if they're in the same or similar sectors or if there's a big event affecting the entire market. So again, if you keep everything on a cash secured basis, that shouldn't be a problem, meaning you have the cash to theoretically accept assignment on all of your open short put positions. Or if you're trading via covered calls, you haven't bought any stock on margin, which of course would be a very dumb thing to do simply because of the interest expenses you would incur. Now, there's one other form of leverage that you have to be careful about if you want to be able to repair a position that moves against you, and that's structuring your option selling trades as credit spreads or vertical spreads. This is a topic that deserves its own video or series of videos, and I actually have a 4-part article series on why credit spreads are so hard to repair over on the Great Option Trading Strategies website that I've linked to in the description. The super quick version is that credit spreads can be used to add protection to a trade, or they can be used to boost the returns on your portfolio, but they can't do both, and it's up to you to make that choice. Here's the rule of thumb. Any credit spread that you can't convert back into a standalone naked position is an over-leveraged position in terms of will you be able to repair it if something goes wrong. That's because rolling and adjusting and managing and repairing credit spreads will require you to continue rolling or buying long offsetting options for that portion of the trade. And the only way that's not going to be cost prohibitive is for you to increase the width of the spread and maybe buy a lot. And that's also going to rapidly expand the position's capital requirements. So if you're trading, say, a 5 to 10 contract credit spread because the initial capital requirements are so little, but if set up as a cash secured put or covered call for income trade where a relatively small opening position size might be just one contract, and then the trade goes against you, you're going to be screwed. You may have had an easily repaired position if set up as a cash secured put or covered call that you're now forced to take a loss on. Let me know in the comments if this makes sense. Finally, I'm not saying that you must never use margin under any circumstances. One of the concepts I teach in the Sleep at Night strategy course is what I call the risk dial. Risk is not a switch where it's either on or off. It's a dial where we determine how much risk we're willing to expose ourselves to. After all, as option sellers, we're getting paid to assume a certain amount of other people's risk. And as long as we don't overdo it, when a trade inevitably goes the wrong way on us, we should be able to manage, renegotiate, and restructure that risk so that we should still come out ahead at the end of the day. Okay, there you go. The 3 biggest option selling mistakes I see that can lead to problem trades. Or the 3 thieves that love to be invited into our portfolios and make it more challenging and sometimes impossible to repair an underwater trade. And those 3 thieves are selling puts or covered calls for income at or near tops, selling puts or covered calls on the stocks of unprofitable businesses, and over-leveraging in any number of ways. Finally, big picture view here. If you approach option selling from the insurance company from hell mindset, remember, you're the one who's supposed to be stealing from Mr. Market, not the other way around. Mr. Market is big and strong. We're small and nimble, and we always have the advantage as long as we play to our strengths rather than trying to go toe-to-toe with him. Selling puts and covered calls at tops or on unprofitable businesses or over-leveraging can quickly turn the tables and give him the advantage. Okay, if you enjoyed this and want more Insurance Company from Hell resources, be sure to check out the channel's other videos and subscribe if you haven't already done so. I've got a backlog of video ideas for you, and I'm trying to post 2 new ones a week. I'm also organizing these videos in various playlist categories, so that should make it easier for you to find the resources that are the most valuable to you. Also, sign up for the Daily Tips newsletter via the pinned comment below. The newsletter is a tremendous option-selling Insurance Company from Hell resource and really complements the YouTube channel, as some topics are better suited in article format and some are better suited in video format. Both resources are all about heads you win, tails Mr. Market loses, and you don't want to miss out by not having the newsletter. You can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategies downloadable library page. Download anything from there, and you'll also begin receiving the Daily Tips newsletter automatically. Heads we win, tails Mr. Market loses. That means you should be coming ahead on virtually all of your trades. Okay, until next time.